A fast loan approval arrived within minutes, then turned into a scam that charged upfront fees without ever releasing any money. The offer came through emails, ads, or direct messages, promising quick approval with minimal checks. The terms looked attractive: low interest, flexible repayment, and immediate access to funds. Applications were processed quickly, often approved without detailed verification. Then came the condition: a small upfront fee to finalize the loan or activate the account. Some paid processing fees, others paid insurance or security deposits, believing the loan was already secured. Across countries, these scams have taken millions from individuals seeking urgent financial support. What looked like fast access to credit was actually a system designed to collect fees without providing any loan. During the late 2010s and early 2020s, loan approval scams expanded globally as online lending platforms and digital finance services grew. These scams were often run by organized groups posing as lenders, brokers, or financial service providers. Victims were targeted through ads, emails, and messages, offering quick loans with minimal requirements. The offers were especially appealing to individuals with urgent financial needs or limited access to traditional credit. In many cases, real company names, logos, and documents were copied to create convincing loan offers. The application process appeared structured, including forms, approvals, and formal-looking agreements. Reports from agencies such as the OAIC and the FTC highlighted increasing complaints about upfront fee loan scams. Losses ranged from small processing fees to thousands of dollars in repeated payments. By the time applicants received approval, they believed the loan was secured and ready for disbursement. The process usually began with a quick application, often requiring minimal information compared to traditional lenders. Responses came fast, sometimes within minutes, confirming approval and outlining the loan terms. The communication felt structured, with formal emails, documents, and contact points that appeared professional. Applicants were told their loan had been approved and was ready for disbursement. Then a condition was introduced: a processing fee, insurance payment, or security deposit required before release. The explanation was framed as standard procedure, often justified as risk coverage or administrative cost. Because approval had already been granted, the request felt like a final step rather than a warning sign. Some were told the fee would be deducted from the loan amount or refunded after release. By the time the payment was made, the applicant believed they were completing the process, not entering a scam. Once the first fee was paid, the process continued with additional requirements that appeared necessary to complete the loan release. Applicants were told there were further steps, such as tax clearance, account activation, or verification charges. Each payment was presented as the final step before funds would be transferred. In some cases, updated documents were sent after each payment to reinforce progress. Communication remained consistent, with reassurances that the loan was approved and only pending release. Victims believed they were moving closer to receiving funds, even as payments increased. Amounts varied, from a few $100s to thousands across multiple transactions. Behind the scenes, no loan was ever processed or prepared for disbursement. By this stage, the interaction had shifted from application to repeated payment without delivery. As the process continued, New conditions were introduced, often framed as compliance or regulatory requirements. Applicants were told additional payments were needed to satisfy lending rules or release restrictions. Each request appeared structured, with explanations referencing policy, verification, or risk management. If delays occurred, reasons were provided to maintain confidence and prevent withdrawal from the process. Some were told their loan amount had increased, requiring higher fees to match the new terms. Others were guided through multiple payment stages over several days, each one presented as necessary. Because the communication remained professional, the requests felt procedural rather than suspicious. Reports showed individuals making repeated payments while waiting for funds that never arrived. By this stage, the system was sustained entirely through continued fees, not any real lending activity. Doubts usually emerged when promised disbursement dates passed without any funds being received. Applicants checked their accounts and found no incoming transfers despite multiple completed payments. Attempts to contact the lender often resulted in delayed responses or new explanations requiring further fees. Some reached out to real financial institutions and discovered no such loan process existed. Others noticed inconsistencies in documents, contact details, or payment instructions. Authorities across multiple countries, including the OAIC and the FCA, have warned about these patterns. By the time the situation was confirmed, several payments had already been made, with no recovery path. Victims realized the approval itself was part of the scam, not a step toward receiving funds. What initially appeared to be fast access to credit unraveled into a system designed to collect fees without delivering any loan. The scam was typically uncovered when victims reported the incident to banks, regulators, or consumer protection agencies after repeated payments with no loan received. Across countries, reports showed consistent patterns: instant approvals, staged documents, and multiple upfront fee requests. Agencies like the OAIC, EFCC, and FTC identified these as coordinated loan fraud operations. Investigations revealed cloned lender websites, copied branding, and scripted communication designed to mimic legitimate financial services. Digital analysis traced domains and contact channels that were frequently changed to avoid detection. Financial tracking showed that payments were routed through multiple accounts and quickly moved across borders. In some cases, the same networks were linked to other scam types, including investment and impersonation fraud. Despite warnings and enforcement efforts, new variations of loan scams continued to appear across platforms. What appeared to be individual lenders was ultimately identified as a structured system designed to extract fees without providing any credit. What made this scam effective was the promise of certainty in a situation where people needed quick financial support. Applicants were not acting unusually. They were following what appeared to be a legitimate lending process. The system created confidence through fast approval, formal documents, and structured communication. Because approval came early, the later payments felt like standard administrative steps rather than warning signs. Investigations showed that the same structure was reused globally, with only branding and contact details changing. This allowed the scam to scale across countries and target individuals under financial pressure. The financial impact often came through multiple small payments rather than a single large loss. For many victims, the realization came only after repeated fees and no funds received. The pattern remains active today, evolving with new platforms but relying on the same core mechanism of selling approval without delivering credit.